when I get back, I'm doing a panel, okay? I'm moderating a panel on indexation, okay, and product innovation. So it's basically what we're doing here, but I'm overseeing a panel of basically experts that have 30 to 40 years experience in developing indexes, particularly in real estate, and have been actively involved in developing real estate-based, index-based capital market products. Okay. Exchange-traded funds, commingled funds, derivatives, single account portfolios, unit trusts, these bonds. These guys have fixed income, CDOs. I mean, they've done a lot of stuff in the real estate space, even though the capital markets in real estate are extremely underdeveloped, extremely underdeveloped. So my goal is to get these guys in a room and pressure them and say, what's wrong with the current indexes out there right now? How can the next generation of scientists like yourself develop new real estate-based indexes that will do a good job of not only tracking the market, but reflect the true underlying volatility associated with real estate. And then, if we can figure out how to develop better indices, we can develop capital market products, CDOs, derivatives, ETFs, all kinds of products off of the indexes, okay? But I'm not going to tell them that I'm in the process of developing a new series of indices and some capital market product. It's a little, doing a little competitive intelligence on my part. So what I'll do is I'll record that session. Then what we can do, if you want, we can watch it and you can take notes on it to see how these guys think. Okay? And they're really amazing people too. All right. So let's do. Did you print those out for me, Sam? Okay. I think somebody else did.
Probably did.
Amelia, did you do that for me?
Carly did.
Carly, thank you. All right. So you want to print them out. You don't want to go back and forth between the pages. Okay. So the first one I want to look at, I'm going to zoom in on this guy. So the first one, did you print them out in order, Carly?
In reverse order, I think.
Did you? Okay, so what does this one say right here? Say, I can't even read it. I might have to go to this one. Oh, here we go. Okay. This one. Okay, so this is number one. So this is what? $sign F, $sign 63, minimum, $sign C36 to $sign C $sign 60, and then here we got $sign C $sign 62 equals 1. GRG nonlinear, and then make blah 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 blah. Okay, I think that's it. So let's do the first one. on your stock portfolio optimization worksheet, so what we're going to do is we're going to run first optimization, which is this one right here. Okay. Can everybody see that? We're going to run this one right here. So we're going to calculate the minimum variance portfolio. So you got to make sure your covariance matrix is already calculated. Here's the instructions right here, okay, for these 3 steps. Okay, and they're over here. And they're on these pages too. They're all over the place. Okay. So what we want to do is I want to get right here. Because what's going to happen is when I run the optimizations, the output is going to print right here. Okay. So this is going to be your output column right here. Okay. And then we're going to run the optimization, then we're going to copy this and put it over here. Then we're going to run the second optimization. We're going to take these cells right here, we're going to copy them, and we're going to put them over here. Then we're going to basically keep running it. I'll show you how to run it. So let's do the minimum variance portfolio first. So what we need to do is go up into data, and I already have added my solver. Did everybody add their data analysis pack and their solver optimization? Is that all done? Is everybody there? Already done? You already did it? Yes? No? Yes? I need confirmation.
Not yet, I'm almost there.
Okay, so you're not there yet? Okay, so I'm going to keep going because I can't wait for you guys. So what I'm going to do is I'm going to go to the, you guys know how to add the solver in?
Yeah.
Okay. So then I'm going to go to solver. It's going to pull it up, and here it is right here. So F, got it, minimum, got it. Oh, and here, this one right here. So we have to get rid of this right here. That one. Okay, so I got rid of that, it's minimum. These are all the same. Non-linear, ready to go. And then watch, this right here will change. It should actually print out to this. Okay, so I'm going to go solve. Make sure you're using Excel 365. Don't use Google, okay, to do this stuff. So it's going to take a while because it's a factorial combinations to calculate the. So there it says, okay, keep solver solution. Okay, I think you can just go okay, and boom, you see how these changed right here. Hello, you see how these changed? So then what you're going to do is you're going to take this right here, don't go to here, don't, right click it, copy it, go over here, right click, and click the values. And bam. So there's the values that go over there. So now you just did the minimum variance portfolio. Okay. Now we got to do the second optimization. Carly, did you print out that second the second optimization?
No.
Yeah, you printed out on a big page like this?
Oh, then I did, yeah. Sorry.
You did, it looks like this. Can you print it out on
Oh,
this?
yeah.
So the second optimization, you go right here to this one. Actually, this should be 2. So here's the second optimization right here. So the first, the set objective is still the same. So the minimum is still the same. The range, change variable cells, is still the same. This line right here, $C, $62 equals 1, that's the same. Now you have to add this SF, sorry, $F, $62 equals $J, $76. Is that correct? Thank you. Can you guys verify that for me? That those are the parameters? Yes, no, yes, no, yes, no? Can you verify that those are the parameters that I should use for the optimization?
I missed the first part, so I don't know.
Okay. Is that right?
Yeah.
Okay. So I can go in, what I want to do is I want to go back to this stock portfolio optimization. I want to go up to data, go to solver, type in solver, and I need to add, right? And this one is going to be what, dollar sign, correct me if I did, make sure I did this right. Dollar sign F, dollar sign 62 equals dollar sign J, dollar sign 76, is that right? Oops. I don't think I did it right. That, I gotta go here, change that to equal, and then put in the constraint, dollar sign J, dollar sign 76. Is that right? So it looks like that. Is that correct? If I add in some errors and I run the optimization, what's going to happen? It's not going to happen, okay? Add garbage in, garbage out. So are those parameters correct for the optimization? Yes, no? You need to double check the work for me, okay? All right? You're going to be working with managing directors and managers. You're going to be working with people. They're going to be asking you questions to verify the work so that they don't screw it up, okay? So when I ask you for some help, I need your help to make sure that we don't screw it up, okay? So is the optimization parameters correct? Okay, great. So now we can run the optimization. So what you want to do is watch this array right here. This is going to change right here, okay? Now, I think I made a mistake. So what I'm going to do is I'm going to run the solver, but I'm going to have to run it again because I made a mistake, okay? So I'm just going to run it. Or actually, it's going to work. I take that back. Okay. And there it is. Okay. So what I was supposed to do before I hit the solve is right here. You see this right here? Cell to store constraint on expected portfolio return. So what's going to happen is what I do is I take this and I link it to this right here. So I'm going to link this to this, okay, for my first iteration, okay. So this is going to link to this. Does everybody know how to link it? No. You hit the equal sign. You go here. Bam. You're done. So now what I did was I set the return constraint. This is the first iteration. This is the first iteration as the start of tracing out the efficient frontier across the different expected returns. So what I did was I took up here, I took the returns that you put in here. These are all my returns. So I basically took the highest, subtracted out the minimum, and divided it by, how many iterations do we have? 15. So I took the high minus the low, divided by 15, and gives me the intervals for the expected returns for the portfolio. Does everybody get that? The highest amongst these stocks right here. I am forecasting for all of my 25 stocks, I am forecasting that Apple's going to do 22%. That's the high. Then the least, the one that's going to be getting the least, is going to be the 3%. Okay. So here, what I did is I created an algorithm right here, And I said, give me the maximum amongst that range, give me the minimum amongst that range. Then, divided by 15 can give me the iterations. So these are the cells right here. So these are the expected returns. This is all calculated for you. Okay. These are the differentials right here. This is the average differential between each of the expected returns on the portfolio. And then what I did was I plugged them all down in here. So this top row right here are the mean returns in the iteration. So this is going to trace out the expected return for your portfolio. So what you need to calculate for your portfolio is the portfolio standard deviation. Now to calculate the portfolio standard deviation at each one of those returns, you got to have the covariance matrix. And you got to be able to run the Markowitz optimization procedure, which is what we just did. Can't do it by hand. Computers can only do it. You can't do it by hand. Only computers can do it. Markowitz, Harry Markowitz won the Nobel Prize. He wrote the program, the engine behind this, to be able to calculate the portfolio standard deviation. He won the Nobel Prize. Okay. So what I did was I basically linked this cell to this cell right here. Then I went to the solver, put in the parameters, clicked on solve, said OK, and boom, the first iteration is right here. And you can see 100% of the portfolio is in Apple. So it's the very tip of the efficient frontier. Okay, and now what we're doing is we're trying to trace out the rest of them. So this is the key right here. You need to follow along. You need to take notes or you're going to screw it up. Okay. So then what you do is you take cell 81 to 107. Right-click it, copy it, put it right here under E81. Right-click it, and use this one all the way to the right. Click on it, and boom, you did the first iteration. Now let's do the second iteration. So now we go up here, take that right there, hit the equal sign, take the 20.7, hit enter, go up to the optimization, click on solver, say solve, If we ran these optimizations in 1950, it would take probably 2 weeks to run this. Now this can be run in what, 20 seconds or less? That's how advanced the computerization's got. So now here's the second iteration. So we take this, copy this, right-click it, copy it, bring it over, right-click it, go over here, and paste it. Oops. Did I do that right? How come it's the same? Should be different. Okay, something's going on here. Something's going on. What did I do? Data, solver, solve it. I'm going to take this, copy it, right-click it. Maybe it's this one, the second one here. Instead of this, oh, the other one links it. Okay, so you want to use this one, the second one. And there you go. Now we take that, you guys should be following along on your spreadsheet, you should be doing this right now. Then take the equal sign, get the second iteration, expect to return, portfolio, click on it, go to data, solver, solve it. Hit OK. Got it. Take this, there, right click it, copy it, bring it over here. Make sure you don't overwrite this and you don't overwrite that. Right click it, paste it, boom, you're done. Now do that for all the rest of them. Okay. Once you've done that, then you do the last optimization right here. This one right here. Once you run that one, what it'll do is it'll solve for this, the capital allocation line right here. So you basically have 17 optimizations that you need to run. The first one to calculate the minimum variance portfolio. Then you got to do the other 15 to trace out to calculate the portfolio standard deviations for each of the expected returns on the portfolio. And then you got to run the last one to calculate the capital allocation line. Once you do that, your efficient frontier and your capital allocation line should look like that. Yours may be a little bit different. We're going to have to maybe mess with the, with the scaling to make it work. But here, this is your right here, the portfolio that is tangent to the capital allocation line is the one that provides you with the highest return to risk ratio. Okay, and I'll show you where that one is. Okay. These portfolios right here, the tangency portfolio, all the way out here, these portfolios are all feasible portfolios. Why would I buy this portfolio? Would I build this portfolio? Test question. Would I build this portfolio? Would I recommend this portfolio to my client? Would I recommend that portfolio to my client? Would I recommend that portfolio to my client?
I mean, it's in the efficient frontier.
What?
It's in the efficient frontier.
Well, tell me about what's the characteristic of this portfolio?
Low risk.
Yeah, risk, low risk. But this portfolio right here is lower risk, and it has higher return. So why would I put them in that portfolio? Would I put somebody in that portfolio?
Yeah.
But I can put them in that portfolio, or that portfolio. Would I put them in any of these portfolios? No. Nope, these are infeasible portfolios. You would actually short these portfolios, or you may even actually, write calls, buy puts, on these portfolios. You would go short, sell short those portfolios. Okay, so these are the only feasible portfolios. This is the portfolio you want, right here. It's going to give you the highest return to risk ratio. Okay, so if you go over here, and this is what I did. Once I ran all of the iterations, I basically unbolded all of the zeros and I bolded all of the positive allocations. Okay. Then what I do is I went here and I looked across the portfolios and I found the portfolio, bolded it, made it red, the one that provided me with the highest return to risk ratio. The expected return divided by the standard deviation. That portfolio right there is your active portfolio optimization allocation. Okay, that's the best portfolio within the ones that you ran. Okay, and then what I did was I took these allocations. I went back to my passive portfolio worksheet, my passive portfolio file, saved it down as an active portfolio file. Then opened up the passive portfolio, went into the target worksheet, played with the market caps or the revenues to replicate these weights. Didn't I already do a forward test? On the passive portfolio, didn't I already do a forward test? Did I also do a back test of 1, 3, 5, 10 years? So if I go back and I replicate these percentages within the passive portfolio worksheet by just adjusting the revenues or the market caps, I now have the back test for my active portfolio. You've already done it. Now you just go back and you just have to adjust the weights. Does everybody get that? Does everybody understand what I'm doing? Hello? If you don't, you need to tell me. Do you understand what I just said? Okay, I'm not getting a read. People are just giving me blank stares. Either you do or you don't. Do you get it or you don't? You don't? Okay, so I'll have to show you. You gotta say something. Okay, if you don't tell me anything, I'm just gonna move on, then you're gonna get lost, then you're gonna screw it up and you're not gonna hit the deadline. Okay, so here is might as well pull up your passive portfolio, save it down as an active file. Because you don't want to screw them both up, or else you're going to have to go back and do them again. Okay, you remember this worksheet? The master targets portfolio? Okay. So what I'm going to do is I'm going to take these allocations right here. Okay. And I'm going to go into my passive and I'm going to start playing with these market caps to get the allocations to replicate these weights. Okay. Once I get these weights replicated in this worksheet by playing with these, I now have the forward test and the back test of my active portfolio. You already got your memo set up. Write up the memo, print out the worksheets, update the PowerPoint presentation from passive to active, and be ready to come back and make a presentation. Okay. You'll be able to work on all this stuff during the week of the midterm week. So when you come in, I would already have all these optimization procedures already done. I would already have the back tests ready to be done, and maybe even have the memo and the spreadsheets already printed out in your PowerPoint presentation ready to go, so that we can start presenting the active portfolios. Okay. And then for those of you who are the technical analysts, you need to start on doing the technical analysis and identifying the buy-sell signals and put that into the profit loss statement. And then the fundamental securities analysts, you guys need to be working with me for your individual stocks so that we can come up with the intrinsic value, so you can calculate the premium discounts to the current stock prices for your 25 stocks. So what you're going to do at some point is you're going to save this worksheet down again, and save this down again as the target, okay, as the target portfolio. And what you're going to do is you're going to look at your passive allocations, you're going to look at your active, you're going to look at your active allocations, and you're going to look at your premium discount calculations from the fundamental securities analysis. And what you're going to do is, from those three portfolio approaches, you are going to come up with a target portfolio allocation. Okay. You're going to come up with a target portfolio scenario. And you're going to mess with these revenues. You're going to come up with the target allocations. Once you set the target allocations along with the minimum maximum exposures, that's the target portfolio that you're going to recommend. So you'll have three products to recommend to the investment committee: a passive portfolio, an active portfolio, and a target portfolio. Those are the three portfolios. And once you set the allocations for the target portfolio, you already have the forward test and you already have the back tests on it. Okay? And then you're going to start putting together your report, okay, on the three portfolios. Then you're going to look at how much money you made from the moving average crossover system, the 10, 30, 50-day crossover. You'll probably make another 100 grand a year over 3 years back tested. That's $300,000 on $1 million. Okay? That's on top of the rate of return that you generated from your portfolio. And if you're good, you mentioned within your presentation and within your report that if you had additional time, you would create a long-short portfolio out of it. You would use the technical trading system to go long-short your positions and to generate more alpha through active trading strategies. And what you could do too is develop a dynamic trading portfolio that actually writes and buys derivative contracts based on the buy-sell signals from the technical securities analysis, and even increase the rate of return on the portfolio significantly for risk-neutral investors or high net worth or ultra-high net worth investors. It's a money machine. Okay, you do this, you implement it, you will have $4 million in your wealth account by the time you're 60 years old. $4 million, if you stick to the program. Okay, can you retire on $4 million? Yeah, because if you get a 10% payout on the $4 million, that's $400,000 of adjusted gross income that you can live off of. Now you're basically you're going to have to pay alternative minimum tax, but still you're going to be able to live a really good life making that amount of money from your investments by the time you're 60. Okay, all right. Any questions on this? Everybody clear on what needs to be done on the technical securities analysis? How to identify the buy and the sell alerts and the signals? You're going to need to work with me. Your fundamental securities analysts are going to need to work with me on the fundamental securities analysis side, walking you through each individual stock to determine the individual multiples and potentially the individual discount rates or expected returns per stock. And then you're going to do the report. I'll bring some of the reports in so you can see what your peers have done prior to you. Okay, any questions? Can you do the optimizations? Do I need to go through it again?
Write it down when you want us to. So you have it.
Okay, cool. What I'd like to do is once you go through the optimizations, you need to take a look at what some of the students did last semester is they basically, they did not wait long enough for the optimization procedure to run its full course. And what they ended up doing was they ended up copying the optimizations midstream. So they weren't fully calculated when they copied them over. So the efficient frontiers were all kinked. And in some cases, they were all messed up. So what they had to do was go back and make sure everything was run correctly, make sure the covariance matrix, make sure the returns were done correctly. They had to re-audit everything and then run through the optimization procedures again a little bit slower to make sure that they were copying over the correct weights for each of the 15 iterations. And then it worked out. Okay. So if you have any problems, let me know. Did you get a haircut, Drew? Yeah, looks good. I like my hair short like that. Okay.
Don't have to give us off.
I know. Okay. Any questions? All right. So I'll be around during the break if you want to work on this stuff together. So let's do finish up the midterm. Was that the week of the break?
Yeah, it's the Friday and Monday.
Yeah, if you want to set something up, I'll meet with you.
Is it,
Yeah.
you said you're gonna be on campus next week some days?
During the break, I'm gonna be here on Wednesday. And then if you want to meet or do something, just let me know.
Okay.
You know, I'll come out.
You're gonna be in here on Wednesday?
The Monday following, you mean,
This coming Wednesday, or no, next, the Wednesday of break.
yeah, the Wednesday break, I'll be back on campus.
Okay.
So we can set something up for then if you want me to look at something. And if you want me to come out that Friday or something, you know, I'll come out during the week. Just let me know.
Okay.
I might have some work stuff, I'm trying to nail down some work. But if that doesn't flush, I'm open the
I'll
whole
just
week.
shoot you a text.
Yeah, I'll be flexible, I'm just gonna be okay. So pull up the, pull up the midterm. So what I'll do is, maybe I won't do it for the midterm. But what I'll do is I'll do it for the final, where where we'll watch the panel discussion on indexation and product innovation, and we'll use that for the, like a take-home final component. We'll do it in class together, okay? And then you can submit that with your deliverable. Okay? All right. Make sure you give me your memos and stuff, and then I'll take a look at this. And then I want to take a look at your PowerPoint presentations. I want to sign off on the memos, the worksheets, and the PowerPoints, so that when you do the active, all of that stuff is cleaned up and you're working with a clean template. Okay? All right? Okay. So where did we lay down? Weren't we getting into the derivatives? Well, what we're doing is, I'm going to review the, we were doing the index methodology. So let's go through the index stuff, because it's really important, especially for you guys, because indexes are the rage. I mean, BlackRock is sitting on what? How big is BlackRock these days? 3 trillion or something crazy, something like that? Is it? Can you Google that and find out? What are the assets under management for BlackRock?
5.9
How much?
5.9.
Jesus, that's amazing. $6 trillion. So basically it's almost, it's like 3 times the largest bank in the United States. B of A is like 2 trillion. So is JP Morgan. So basically one company has assets under management, basically almost like 3 times the largest bank. That's amazing. Right? So indexation, exchange traded funds, factor tilt portfolios, factor portfolios, factor weighted portfolios, indexed portfolios is the rage, okay? It has been. And BlackRock is a perfect example of the popularity of that type of product, okay? So what we were trying to do was to build real estate indexes, okay? It's not easy to do, because I don't have continuous time pricing for the individual shares within the portfolio. I don't have that luxury. That's one of the problems with real estate. I need transactions. Transactions take a long time to get into the system. I never have enough transactions. So I got to aggregate them. I got to create a carryover procedure. I got to manipulate, my time capture period to get enough transactions. I have to be a little bit more innovative than the stock or the fixed income portfolios. So I went through the index development and the research steps, collected the transactions data from multiple sources, aggregated the metro areas to pool the sample of transactions to get a large enough sample, and then we had to develop a carryover procedure to increase the transaction counts even more to be able to calculate means. We coded every single property transaction that occurred by property class, by property sector, and by geographic location. So we got 5,000 transactions per month. And of those 5,000 transactions, we threw out about 3,000, we ended up with 2,000. Then we invoked the carryover procedure and got the counts back up to 5,000. Okay? So we are always struggling with transaction counts.
And why'd you throw out 3,000?
Because there was a lot of duplicates
Oh, okay.
in there, and there was like medical office, we didn't include that, we didn't include manufacturing, we didn't include student housing, assisted living. We were looking for pure play real estate transactions, bread and butter, warehouse distribution, office buildings, apartment buildings, and retail shopping centers. Okay? So a lot of this, we ended up having to throw out a lot of stuff. And another one of our problems too, that we ran into is some of these geographic locations, some of these states are non-disclosure states. So the principals can transact a transaction, but they don't have to record it. So the transaction never occurs. So these are the areas in which the majority of real estate is located. These are the states that actually record the transactions, so I can get recorded transactions. But a lot of these other states, especially Texas and parts of the South, there was no transaction records. The people who transacted, the people who bought the properties and sold the properties did not have to disclose what the property sold for. So we have no data, we have no information. Okay. And we coded them, and we collected them, the data over time. So it was 3-month lags. So I had 3 months lag data. Transactions in June and July could have come in August, September, and October. Then we shut down basically the data collection. We process the transactions, the indexes in November. We basically sit on them in December, and then we give them to Standard & Poor's the first week of January, and they publish them the second to last Tuesday of every month. So there's a publication schedule. Okay. And then there was all kinds of press release that would come out around the published indexes. We pulled all of the transactions and calculated the price per square foot. And then what we did was we pulled the data by geography, property sector, and by property class, logged all of the price per square feet to create a normal distribution, filtered out the outliers, converted it back, and calculated the mean price per square foot. Okay. So our index methodology was exactly the same as the S&P 500. The total inventory times the weighted average price per square foot was the aggregate value. Divide the aggregate value from today by the aggregate value from yesterday, times 100 gives us the index level. Okay. We could have used, if we used 100, we could have used 1,000. Okay. The S&P 500 uses 1,000. And then here were the aggregate values. So the weighted average price per square foot times the inventory gives us the aggregate value. I can sum up the aggregate values across the metro groups to get the aggregate value for all apartments in the United States. The aggregate value. Divided by the divisor, multiplied by 100, I could get an apartment index. We do the same thing, add up for the Boston metro area, metro group area, I could calculate the aggregate values across the different property sectors, sum it up for the geography, divided by the aggregate value from the prior period times 100, I could get an index for this geographic region right here. So I could do geographic sector indexes. I could do regional sector indexes. I could do sector indexes. I could do a national composite index.
Wait, so the aggregate value of today minus the aggregate value from yesterday?
Okay, no, it's the aggregate value today divided by the aggregate value of yesterday.
The first you said? The very first one
Yeah.
you said? Wasn't the aggregate value of today minus the aggregate?
No, it's divided.
Okay, and that gets you the index?
Yeah, so I can show you. So you're gonna take your price, right, your weighted average price per square foot, times the inventory, the size of the market. This is gonna be T plus 1, this is today. And then you're gonna divide that by the price times the quantity, and actually the quantity doesn't change. And this is gonna be T equals 0. So this is yesterday, this is today. So the only thing that changes is the price. Okay, this doesn't change. So this is called the divisor. This is called the base period divisor. It's called the base period divisor. This is how the S&P 500 is constructed. We were replicating the S&P 500 methodology to calculate it. So this could have been, I think we started in 1998. And this would be what, 2018. So this doesn't change. This is the only thing that changes. And really the only thing that changes is that. Okay. Then we take this and multiply it by 100, and we get the index level. So at the beginning of the time series, here, the index is 100. And then over time, it's going to go something like that. And these are the recessions, and these are the peaks in the market. Do you get that? Did I say minus? Okay. Let's get to the, and this was the carryover procedure. So this was extremely helpful because we got 5,000 transactions down to 2,000 transactions, didn't have enough transactions, so we used the carryover procedure to be able to bring transactions over to get the sample sizes high enough to be able to calculate the mean prices per square foot. This is not used in the S&P 500 because you have plenty of data. So here was the flow chart. So this basically walks through the methodology. So the data, the transaction data comes into the information system. And we were getting data from like 4 different sources and 4 different formats. So you got to do some data processing. Then you had to geocode it by metro area, but we geocoded it all the way down to the zip code level. Then we checked for duplicates. So we ran through a manual and a non-manual duplication process and threw out the duplicate transactions. Then we coded all of the properties by quality class, okay? And then we processed the data again. And then we did another quality control check for verification and validation. So what we would do is we would take data from different sources, compare them, and if they matched up, we knew that our quality of transactions was really high, the verification validation. Then we logged each of the individual transactions by price per square foot to create the distribution. Filtered out the outliers, converted it back, and then pooled the data by metro group. Then we did the precision calculation, carried over the transactions for the areas that we needed to carry over because we didn't have enough transaction counts. Calculated the mean prices per square foot by geography, property sector, and by quality class. Once we got the mean price per square foot, we then weighted the different prices by quality class to get the sector weighted average price per square foot, times the inventory to get the aggregate value, take the aggregate values divided by the divisors, times 100 to get the index level. So those were the processes we went through. The reason why we did this much detail is because we knew we were going to get audited and we knew we were going to get sued at some point in time. So we had to adhere to very high compliance and very high reporting standards. Yes,
So you were gonna get sued?
that's correct. That's right. You might as well just know right now you're probably going to get sued at some point in your life and be prepared for it. So if you're building indexes like these that are going to trade property derivatives with notional values in the millions of dollars or billions of dollars, and the trades go bad, they're going to audit you and see what you did and how you built the indexes. Okay. So we wanted to be prepared. We're using basically accounting audit standards and using state-of-the-art information system project management protocols to be able to document everything and make sure everything was done, and then vet it by everybody to make sure it was blessed and signed off on. So here are the actual indices. Now what you want from indices is you don't want straight lines. What you want is you want squiggly lines, okay? Because this is the random white noise associated with a price index, okay? So you want cyclicality and you want volatility in your indices. But you want to have enough volatility to meet the traders' requirements for the derivative exchange traders and have enough cyclicality for the institutional investors, but not have too much volatility to scare off the institutional investors. So you have to make a compromise between the two. So then what I did was I calculated the year-over-year change on a monthly basis for each of the individual indexes. And basically what you can see is there's volatility in the returns, but there's also cyclicality in the returns. And then what I did was I went back and I checked for cyclicality and volatility in the indices. The first thing that I checked for in regards to cyclicality is were the indices highly correlated with the overall business cycle, for one? And were the indices highly correlated to the overall real estate cycle? So basically I looked at economic indicators and I looked at other commercial real estate indexes to validate our indices. And we knew that we were in a recession in 91, 92, 93. So this looks right. We knew that we were in a peak in 1997, 98, 99, 2000. Okay, verified. We knew that we were in a recession in 2001, 2, and 3. We knew that we were in a peak in 2006 and 7, and I wish I had the 2008, 9, 10, and I wish I had the rest of the last 10-year time series. I don't. And then what I did was I knew that some of these property sectors, particularly office, at certain peaks in the real estate cycle, their annual appreciation rates had peaked at around 20%. So I could basically toggle the T statistic to create volatility and amplitude in the returns, and then I just like, that's it, and then plugged it in and set this. Okay, yeah, go ahead.
No, you just talked about it, but I was gonna ask, for like the local office market, was that?
Yeah, this was national office.
Okay. I was gonna ask how correlated it was with.
The local?
Yeah.
Yeah, I could have created these indices doing like San Francisco office. And what I would have done is I would have ran a regression against the national office, against the San Francisco office to calculate the beta. Right, so what would you assume? Would you think that the beta is less than, equal to, or greater than 1 for San Francisco office? What would be the beta? With the beta against benchmark, the San Francisco office market benchmarked against the national office market, what do you think the beta would be for San Francisco office? Less than 1, equal to 1, or greater than 1? What would be the beta? Well, tell me about San Francisco's office market. It would be greater than, because who occupies the majority of the space? Tech. Is tech a stable industry class? No, it's highly volatile. So if the returns on the San Francisco office market are highly driven by occupancy and demand by tech tenants, then you're going to have you know, it's gonna be more volatile than the national office, which means that the beta is gonna be probably significantly higher than 1. Which means that if you're using CAPM, that the expected return on the San Francisco office market is gonna be significantly higher than the national office market. And there's probably gonna be some alpha, right? So the national market was returning 10%, San Francisco returns, you know, 20%, you know, at the peak of the cycle. So you got a 1,000 basis point alpha differential between the two. Spreads and the beta, okay? That's how you assess the markets. Okay, index analysis. So the first thing I did was, okay, we got a national index. Is it correlated to industrial production and non-farm employment? These are the 2 factors that drive demand for commercial real estate. So as you can see, they are highly correlated to each other. Right? And this is the index here. So it looks like industrial production would bottom first, then the commercial real estate market, and then the labor market. So this is a leading indicator, this is coincident, this is lagging. We all know, as economists, we know that employment is a lagging indicator. We know production is a leading indicator. So our national index is a coincident indicator. So it could have been used as a coincident indicator along with GDP. And we're actually publishing it on a monthly basis, as opposed to GDP that's published on a quarterly basis. So what we found is that the indices appear to lead the troughs and lag the peaks. And we were able to prove that here. So here you can see that they led the troughs in this case, and they lag the peaks. Okay, just by looking at lead lags around them. And it looks like it was a coincident indicator in the 08 recession. And then I basically ran very simple regressions using the indexes, real estate indexes as dependent variables. These were the independent variables. Ran the regressions, came up with the adjusted R's. Here's the T statistics, so they turned out to be statistically significant. And then we were able to identify what degree of correlation these economic factors have with the real estate price indexes. So I was guiding the market on how to forecast these things. If you can forecast these indexes, and I think the indexes are going to go down based on our forecast, what would you do as a derivatives trader?
You think that they're gonna go down?
Yeah. So if I basically take these economic factors, these are pointing down. I know that these indexes are going to go down. If I was a property derivatives trader and I'm forecasting these indexes to go down, what would be my trades? What? What would be my derivative trades? If I'm a property derivatives trader and I'm using Larry's economic factors to forecast the prices of commercial real estate going forward. And if I think the prices of commercial real estate are going down based on these indexes, what would be my derivative trades? I would do what? Would I be buying or writing if I think they're going down? What? I'd be writing forwards, writing futures, writing calls on futures, buying puts on futures. That's what I was trying to do. Then we looked at our commercial real estate index compared to other indexes. Are they correlated? Yeah. We're about 60 to 70% correlated with the other indexes. So now that you have the indexes, you've got the methodology vetted, you're auditing it, publishing it, systems are in place, everybody's written off on it, you've talked to everybody on Wall Street, explained to them how the indexes are constructed. Once the methodologies are validated, then the exchanges and the over-the-counter market participants will start to write and develop the contracts. Okay. So our question was, well, how big is this market going to be? At the time, the global real estate market was 15 trillion. That's pretty good. On the debt side in the US, it was 5.3 trillion. The REITs at that time were 330 billion, they're about a trillion now in market cap. The CMBS market was issuing about 170 billion a year, average of about 80 billion, so a lot. Bank loans on commercial mortgages was about 2 trillion in origination annually. And then derivatives, just overall, the total derivatives market at the time was about 5.4 trillion in notional. Now it's about, I don't know, 100, 300 trillion, something like that, something crazy. Like that's when the whole derivative market has just exploded over the last 10 years. And we figured if we could just get, a fraction of a percent of the total derivative market, we could be looking at a market, in its initial innovator, early adoption phase, of about 106 billion, and if we got just 1% of that, we could be making maybe $100 million a year off this product. So then people were asking me constantly, well, how does the derivative product compare to other real estate capital markets products that have been developed historically? So I went back and I said, well, okay, well in the 60s and 70s, they introduced REIT product in limited partnerships. They went through these are the technologies, the securities of the technologies, right, to channel capital. And so these are the S curves. And then in the 80s, commingled funds were introduced, basically closed-end funds that were basically designed for small institutional investors that wanted to participate in real estate they couldn't afford to buy property themselves, so they bought into it, okay? Managed by an advisor. And then in 90 and 2000, you had the commercial mortgage-backed securities market, and the REIT market recapitalized and then emerged and moved into early majority adoption phase. And we believe that the 2000s period would have been the
Hey, but it's still recording those.
yeah, still recording. And so we thought the property derivatives, in the synthetic market, and these new capital market instruments would capitalize, and this would be the new way to invest in real estate and to hedge off the portfolios. And so the panel discussion I'm doing on Thursday is to put some pressure on these experts and say, what indexes have been developed since? What capital market products have been developed? What do we tell you as the next generation of index developers? How are you going to develop new indexes, and how are you going to develop new real estate product going forward? Because we're all in our 60s and 70s, and some of us are in our 80s. We're not going to be around for the next 40 years. So you're going to be responsible to generate new product going forward, if that's something that you want to do, as a career. I think we might have to call it. I can do this later. Because I want to do it on here. What? Yeah. It feels like the health and safety is not air conditioning and stuff like that. Plus, if something does happen, like a fire or something, I don't want to be responsible for taking the back. Because of my inflated ego. Oh, what?